Hi, my name is Joe Perfetti. I'm a professor of finance, and today I'd like to talk to you about financial statement analysis. Financial statements can be daunting. It really means understanding and learning a different language. And today I'd like to help you understand that language, and more importantly, help you understand the story that financial statements can tell you about an organization. When we think about financial statements, there's generally three types of financial statements. They're all based on the same cash flows, but they have different purposes and ultimately they have different points of view. The first is what I would call the external statements. These are the statements that are provided to investors and others to give a general perspective of how the organization is doing. In the US, they're put into a format, a common format across companies, using what's known as generally accepted accounting principles or GAAP. And for international companies, they're put into a format using a set of standard rules called International Financial Reporting Standards or IFRS. And so basically, what the accounting organizations through the government regulatory bodies have done is that they have created these standardized formats that companies must report on so that no matter what industry you're looking at or what type of your company you're trying to analyze, you can see the information in a commonly accepted format. That's the idea. The reality is a little bit different because unfortunately, even though it's in a common format, there are lots of exceptions and lots of nuances, and that's one of the things that we're going to discuss here today. But the key point and the key purpose of these statements is to provide information to investors and creditors to help them understand how the company is doing so that companies can attract capital. In the US, a good source for information on financial statements is actually the US government, www.sec.gov, which is the Securities and Exchange Commission website. They have a database called EDGAR, and the financial statements of publicly traded companies in the US are available there electronically, free of charge, and in pretty much real time from the point that the company discloses them. On an annualized basis, a company's annual report is called a Form 10-K in the US. A quarterly report is called a Form 10-Q, and any significant information that has to be reported between the quarterly reports is filed on what's called a Form 8-K. All of those are freely available at this website, and many investor services will cull this website to gather information based on what is reported by companies. The second type of reporting is what I would like to think of as internal or management reporting. This is how a company looks at itself and how it evaluates itself. Main challenge with that is there really are no rules that companies have to follow. Companies can choose to evaluate themselves any way they want, and they often do. Now, they're loosely based on external rules, but they don't have to follow the external rules. And so it's very important to understand your internal statements by asking questions about how they're actually prepared, what are some of the nuances for the categories, and to understand that ultimately it's about decision making internally for the company, and the management reporting structure is set up to do that. The third type of reporting is what is I would call tax reporting. The governments actually make you file a different set of books under a different set of rules so they can decide how much to tax you. And so this actually is what leads to confusion. We're looking at the same cash flows, and they're all statements are reporting those cash flows, but they're reporting them with three sets of rules. There's a set of rules for the external, there's a set of rules for the internal, there's a set of rules for the tax. And it's very confusing to look at three statements that look different, even though they're looking at the same information. That's one of the challenges. So for purposes of today, what I'm going to talk about are more of the external rules. If we're looking at a company for either analytical purposes or potentially investor purposes, what are some of the key performance metrics that we would evaluate, and what kind of story can we get from the financial statements? So here's where I'd like to start. This is a representation of what's called the cash flow cycle or cash cycle of a business, also known as a business model. And all companies go through this cash cycle. As a matter of fact, the first stage of the cash cycle is what's known as raising capital. Before we do anything, we have to get money from investors in the form of debt or equity to finance our business. We then make investments. We buy assets. We create inventory or products or services ready to be sold to the customers. We then run our operations where we're selling our product or service. We're getting paid by our customers. We have some additional operating expense, and hopefully we generate a profit. We then take this cash and then we we start returning the capital back to the investors. Interest to bondholders and banks, dividends to the shareholders. And we have to make an important decision. Do we return all the cash back to the investors, or do we invest it for future cycles of the business? So ultimately, understanding the financial performance of the business is another way of saying, how do we understand what's happening in this cash cycle? Because as an investor, one of the important things that we're going to look at is that if we put cash into the business here in the raising capital cycle, does more cash come out of the cycle than we put in once we've completed a cycle? So in order to help us understand this cycle, because it's happening constantly and continuously, we have financial statements. And they give us snapshots of the cycle at different points in time to give us a sense of how we're doing. So the first two stages of the cash cycle, raising capital and making investments, are measured by a statement called the balance sheet. And the operating side of the cash cycle, to try and figure out whether we're generating more cash than we spend, is measured by a second statement called the income statement, also known as the profit and loss statement. And those are the two statements we're going to cover today. But again, the insight that these statements provide us is how we're doing on this continuous cash cycle to really understand if we're making progress in generating more cash than we spend. That's really the goal that the financial statements are trying to help us understand. So what I'm going to do is I'm going to use Toyota, the car company, as our example company to give us a sense of what these statements tell us about the financial performance of a company. So in this case, this is 2013, and these are the statements that Toyota released in 2013 for their financial performance. Now, Toyota, being a Japanese company, released all their numbers in yen. I'll just let you know that in this presentation, I've actually converted all of these to dollars to make it a little bit easier for an international audience and a US audience to understand. So in this case, this is the format of a statement that they're presented. Unfortunately, it's called the consolidated statement of income. That's what's also known as the income statement. And this is following the generally accepted accounting principles. And so what I'm going to do is talk to you about what are the key things that we're going to look for on this statement and what it is telling us about Toyota's business. This is often known as the P&L, or profit and loss statement. And ultimately, what an income statement does is it helps us measure the financial performance. And what you have to understand is the income statement is what's called a period statement, which means it looks at all the activity over a period of time. Now, the Toyota statement, this is an annual statement, but it can also be a quarterly statement or even a monthly statement. Typically, for internal purposes, it's monthly. For external purposes, quarterly or annually. And it looks at all the activity that occurs during the period of time. Now, what the accountants do is, in order to look at an activity in the period of time, they follow what's known as the matching principle. And what they do is they try and match revenue with expenses. And what the income statement really represents is what we call an ability to generate the cash. So income, net income, or net profit, represents the cash the company will eventually generate, but it may not be the cash the company is generating during the period of time. So one of the challenges with income statements is income statements show you what your eventual cash flow is, but it doesn't show you your actual cash flow today. Think of it as if you're a worker drawing a paycheck. An income statement is like your pay stub. It tells you what you were paid or will be paid, but it's not the cash itself. And that's the point of the income statement. So what is really on an income statement? First, it has what's called revenue, which is a representation of all the cash that is being invoiced and cash that will be collected, so cash coming in, minus expenses. These are the expenses. This is the cash going out of the business. So net income is the difference between cash coming in and cash going out. So again, very important for management investors to understand, are we generating more cash than we spend? How much is that? That's what net income or net profit tells us about a business. So in order to better understand the cash coming in and out of the business, what we'll do is we'll break the expenses into a series of categories or key indicators to tell us about the business performance. The first category of expense is something known as cost of goods sold, or some people will call this cost of sales or cost of revenue. What these represent, and here's the key word, direct, the direct expenses associated with a product or service. So if I'm making a product at Toyota for a car, it's all the costs that go into making the car. The direct labor, the people actually manufacturing the car, the parts, the inventory associated with that car, the manufacturing line, the facility that's making it, all the costs directly associated with manufacturing the product go into what's called cost of goods sold, or COGS, C-O-G-S. Now, what the company will then do is it will also have some other costs associated with running its business. These are known as indirect costs. They're not the cost to make the car, but they're the cost to run the business day to day. The cost of leadership, the cost of shared services, the selling, general, marketing expense, the research and development expense. Those are what are known as selling, general, and administrative, or SG&A costs. These are indirect expenses. Some people will call this overhead. And that is an important distinction because there is some discretion by the firm and the accounting as to which costs go into direct and which costs go into indirect expense. Because it is a question of what's the real cost associated with a product, and they can vary business by business. But the general idea is if you see a cost of goods sold, it should be the direct cost of making a product, the SG&A, the indirect additional cost that you're spending to run the business, again, what people call overhead. Now, theoretically, most of the cost of goods sold and SG&A are cash costs. The company has a third type of expense, which is known as a non-cash cost, which is depreciation. And depreciation expense comes from really tax rules. What the government wants to do is they actually want you to pay more taxes. So when you buy what's called a long-term asset, such as a building or even a computer, what they will do is they will make you spread the expense over time. So let's say we're spending $1 million on a building. What the government's going to say is, how long is that building going to last? We think it might last 20 years. So we don't get to expense $1 million for the cost of the building. We get to expense $1 million over 20 years. And they will let you take a little bit of expense each year for 20 years. That expense that you can take each year for 20 years as a cost of doing business is called depreciation. Now, in finance, depreciation is what's considered a non-cash expense because when I bought the building, I spent $1 million. I didn't spend $1 million spread over 20 years. I spent it all at once. So from a cash perspective, I spend the money now. But from an income perspective and an expense perspective, I have essentially $50,000 of expense each year for 20 years. And that's all I can deduct on my taxes. So that's the concept of depreciation. And that's getting back to why income and cash in the short run can have differences. Because I spent cash, but I can't call it an expense. So depreciation represents the cost of what's often called property, plant, and equipment, long-term investments in facilities, and major software IT projects that are spread out over a longer period of time. Next category of expense is what's called financing cost. This would be the interest expense that we're paying on our debt, which is a cost of doing business. And finally, another category is called taxes. So these are the 5 categories of expense. So on an income statement, there's a series of indicators that we're going to check to see how we're doing against those categories of expense, to see how we're doing along the way. The first indicator is what's known as our gross profit or gross margin. And usually people call the dollar amount gross profit and the percentage amount gross margin, but it's basically the revenue minus the cost of goods sold. So it's what's left after we pay the direct expense. And that's what's known as the gross profit. And that's what's available to pay the rest of our expenses and make a profit. But what it's indicative of is the markup or the margin of our products. The second expense category that we're going to then subtract is the operating expenses, the selling, general, administrative, or overhead, the indirect costs from our gross profit. And that's going to get us something called EBITDA. EBITDA represents the cash profit from running the operations of the business after the direct and indirect expenses have been accounted for. We then subtract out the non-cash depreciation, and that gets us something known as EBIT, earnings before interest and tax, or also known as operating income or operating profit. This is how much money the business is making running its business day to day. We then pay our interest, we then pay our tax, and what we're left with is something called net income or profit. So these become 4 key performance indicators. So in the context of Toyota, I'm just going to go through these in a few minutes with some real data to give you some insight into what it's telling us about the business. The other statement that we're going to look at is known as the balance sheet. And again, the balance sheet is helping us measure, back to the cash cycle, both the investment part of the cycle and the financing part of the cycle. Where did the money come from in financing? Where did the money go in investing? So that's where the assets come in. Assets represent what we spent the money on. Liabilities and equity is who we owe. So a balance sheet measures investment, and it also tracks the financing. What's different about a balance sheet than an income statement is where an income statement looks at a period of time, a month, a quarter, a year, a snapshot of a balance sheet is at a point in time. It's today. How much cumulatively have we invested as of today? What do we own as of today? So a balance sheet is as a particular day. And so the best way to think about a balance sheet is if you ever purchase a home. If you buy the house is the asset. If you finance the house with a bank, a mortgage, that's the liability, and your down payment is the equity. So the mortgage plus the down payment is what you spend in the house. So in the balance sheet, we would actually match the two together. How much you spend in the house would be the asset. How much you owe the bank and how much you put in and owe yourself, essentially, would be the liabilities and the equity. And what's key is that investment equals financing. Whatever I spent, the money had to come from somewhere. So the balance sheet essentially matches it up. And it involves the concept of what's called double entry accounting. So I always track where the money came from, and I always track where the money went. This was a process created by Luca Pacioli back in 1494. So here's the key. When accountants put the balance sheet into play, they're tracking all these expenses. They actually track them at what's called book value or historical cost, meaning what you originally spent, as opposed to what it's worth today. And the main reason they do that is it's too difficult to figure out the market value on a daily basis of assets, so the accountants don't. They actually just track what was originally spent. So oftentimes people will tell you a balance sheet tells you what you're worth. It really doesn't. It tells you what you've historically spent, and what you've historically spent may be worth more or less today. So that's one of the challenges with a balance sheet. It doesn't really give us a sense of value, but it does track our spending. And that's why it's a useful statement, because it tells us what we spent and it tells us where the money came from and who we owe money to based on what was originally spent. The other key item to a balance sheet is a balance sheet lists what are known as tangible assets, meaning things that you purchased, things that you can touch and feel, things that you've assigned a value to by buying them. What a balance sheet doesn't list is intangible assets, the value of a brand, the value of the patents, the values of the employee know-how. That's not on a balance sheet. So it's important to understand that a balance sheet is going to list things that we purchase, not things that we purchased that created other intellectual property. All of what we call IP is not on a balance sheet, with the following exception. If you purchase IP, you purchase something from somebody else that is intangible, you can actually make it tangible on your balance sheet because you've assigned a value to it. You bought it at an arm's length transaction as a third party. So if you ever see intangible assets, one of them being an example of what's called goodwill, where you buy another company, the premium you pay for that company is called goodwill, showing up in your balance sheet, that comes from a purchase of the intangible assets. If you build them yourself, not on your balance sheet. If you purchase them, on your balance sheet. Okay, so with that in mind, let's talk a little bit about the assets. Assets are listed in order of liquidity on a balance sheet, which means the things that are closest to cash are listed first. The things that'll take longer to convert into cash are listed last. So one of the categories of assets are called current assets or short-term assets. The rule of thumb is anything that can be converted into cash in less than a year is a short-term or a current asset. Anything that takes longer than a year is what's known as a long-term or a fixed asset. Same thing is true in liabilities and equity. Liabilities and equity are listed in order of which they are to be paid. The things with the highest priority are listed first. The things with the lowest priority are listed last. So again, you may not know what the item is, but just look at where it is compared to the other items. The things that are near the top are going to have the higher priority. In this case, anything that must be paid within a year is called a current liability or short-term liability. Anything that's due after a year is called a longer-term liability. And finally, there is equity. The nice thing about equity in a balance sheet is beyond the fact that it's double entry accounting, equity is what's left after everybody else has been paid. And so in a way, equity is what's known as a plug. So as liabilities go up and the assets don't change, equity goes down. If liabilities go down and the assets don't change, equity goes up. So equity is what ultimately forces the balance sheet to balance and what belongs to the owners. Assets minus the liabilities is another way of representing what's called net worth. And again, equity is what belongs to the owners. So therefore, it's the investment of the owners in the business. So that's the structure of the financial statements. Now, let's try and understand the story that it's telling us and the key metrics that will matter to investors, or what I like to call the metrics that matter. Well, if I'm looking at an income statement, I'm going to ask a series of questions. And here's the metrics that will help me answer them. One of the first questions I'm going to ask is, how profitable is the company I'm looking at? So in this case, how profitable is Toyota? And that metric is known as return on sales as a ratio, ROS. And to get that, I divide the profit or the income divided by sales, and it tells me profit per unit of revenue. Obviously, higher is better. So I would go back to the Toyota income statement, and these are 5 years of net income or net profit that I got right off the income statement. This is 5 years of historical sales or revenue. I divide the two together, and that gets the percentage of profit generated each year, return on sales. So again, how profitable is Toyota? In 2009, every time they sold a car, they lost 2.1 cents, what's called bottom line after all expenses are paid. They had a loss. In 2010, they started making a little bit of a profit. They made 1.1 cent. In 2011, 2.1. 2012, 1.5%. And by 2013, they made 4.4 cents of profit for every unit sold. In this case, I've translated these into dollars. So again, you can see the trend is that Toyota is getting more profitable over this 5-year period of time. And now they're making a little over 4 cents per dollar sold. Next question we might want to ask is understanding the details of the profitability. So I said there were key metrics that we look along the way. One of the first metrics was that gross profit or gross margin. And for simplicity, I'm calling it the gross profit margin. But this is a representation of the markup for Toyota. The price minus the cost of direct cost of making their cars, the products or service that they're selling. So to get my gross profit, which often is reported by a company, or if not, I can calculate it quickly by taking the sales or revenue minus the cost of goods sold or the cost of sales. And what's left is the gross profit in dollars. So if I take the gross profit in dollars and I divide by the annual sales or revenue, I then get what's called the gross profit margin or gross margin. And in this case, this is my markup. This is my pricing power, the difference between the price and the cost of the product. So I want to check this over time. And what we see is in 2009, Toyota's gross profit was 10%. By 2013, it had raised to 15.5%. So not only are they making more money relative to their cost, they're actually getting better pricing power over time. And I think that's an important metric to track for a company. Next, what is the day-to-day cost to run the business? What are they spending on overhead? That's the SG&A ratio, the selling general administrative expenses divided by sales or revenue. Again, lower is better. From the annual report, these are the selling general administrative expenses in dollars. These are the sales or revenue per year. If I divide, I can see that for every dollar in 2009, they were spending 5.1% of that on SG&A. In 2013, they were only spending 4.5% to essentially sell the same dollar of revenue. So you can see that Toyota is, on a profitability standpoint, getting better margins on making their cars, and their cost of doing business is lower, so they're getting more efficient with their spending. So some people would call this productivity of spending. So we can see two important trends that are happening with Toyota simultaneously, which are both favorable financially to the company. Now, when I put these two numbers together and I take the cost of goods sold, therefore the gross profit, and then I subtract out the cost of doing business, what I then have is my cash operating profit running my business. And that's something called EBITDA, earnings before interest, tax, depreciation, and amortization. So if I take out, again, the cost of goods sold and I'm left with the gross profit, subtract my operating expenses. So once I paid out those direct and indirect expenses, what's left? And in 2009, it was 5%. By 2013, it had more than doubled to 11%. Why are they making so much more cash profit from running their business? Because they're making more on every car they sell, and it costs them less simultaneously to run their business, so that is helping with their gross profit. Helping with their EBITDA margin. And now they're making 11 cents of cash profit for every unit that they sell. So again, a much more profitable organization and therefore a much more valuable organization. Next, they have to take out depreciation and amortization. EBITDA does not include that long-term spending that's being spread over time on buildings and facilities. And eventually those costs have to be recaptured. So when we take out the non-cash cost of that depreciation that's being spread out over time from EBITDA, EBITDA minus depreciation and amortization, minus the DA, is what's called EBIT, earnings before interest and tax, also known as your operating profit or your operating margin. Those terms are used pretty interchangeably. And what I'll do is I'll take that as a percentage of sales. So this, with reinvestment, is the overall level of profit that the business is going to make. Because remember, I'm going to have to take some of that cash profit and reinvest it. There's an assumption that that depreciation and amortization has to at least be reinvested to cover the existing business. So in this case, this is the overall level profitability of the operations, a very key metric in evaluating a company. So it says, how profitable are you before any type of financing is applied? This is the amount of money the business actually makes running its business. In 2009, they were losing 2%. So even though they were making a cash profit, when they threw in having to recover the cost of what they had spent in their facilities, in 2009, they were losing 2.2%. They had a loss of $4.6 billion on $205 billion of sales. By 2013, their operating margin had turned positive to 6%, even covering their expenses for their non-cash expenses for the buildings. So again, almost $16 billion of EBIT on $267 billion worth of sales. So again, this is another key metric. Next question is we're going to start looking at the balance sheet. Now, what's interesting about the balance sheet ratios is that investors actually look at the balance sheet in combination with the income statement. So the idea is, as I have activity, as I sell things, how much do I have to spend, invest in order to generate sales? How much do I have to spend and invest in order to run my business day to day? So typically the way we actually evaluate the balance sheet is in context of the income statement. So one of the first questions we might ask ourselves, getting back to the notion of the cash cycle, is how long does it take us to get paid? From the time we invoice to the time we collect, what is that period of time? So for Toyota, how long between the time they ship a car to a dealer and the time the dealer pays them? Well, one of the metrics on the balance sheet is called accounts receivable, and that represents the total amount of unpaid invoices from the time a product is shipped or delivered or service is sold to the time that we collect the cash. So that outstanding amount was, in 2013, $75,242 million, right off the balance sheet. $267 billion of sales. Here's the formula. I take my accounts receivable, I divide by my annual sales or revenue. That's the percentage of the year that it's taking me to tie up the cash. I multiply that by 365 days, and it tells me that on average, it's taking Toyota 103 days, 102.8 days, to get paid once it ships its product. In 2009, that was 94.6 days. So one of the things that I can see over 5 years is that Toyota is taking longer to get paid. And this is important because if I take $75 billion worth of receivables, 75,242, and I divide it by that 102.8 days, then that tells me that 1 day of accounts receivable is $731.6 million tied up. So what's the impact of an extra 8 days? You're looking at well over 5.5, almost $6 billion of cash that's being tied up just from those extra 8 days that they have slowed down over the last 5 years. So this is a really key metric to look at because it's not only the length of time, which we could eventually have bad debt, but it ties up a lot of cash. The next question I would like to look at is what I would call the inventory days, or how long does it take us to sell the inventory for the time we make it. In Toyota's case, to get inventory days, I need to know two things. One, what is the value of inventory in the balance sheet? And two, what is the annualized cost of goods sold or cost of sales? And the reason why I use cost of goods sold rather than sales is that inventory represents all the costs that are being allocated for products that haven't yet been sold. They show up in the balance sheet in what's called inventory. And then when they are sold, they actually show up on the income statement as cost of goods sold. They don't show up as revenue because it's the cost of the products that we're selling, that direct cost. So inventory is just an expense waiting to happen. So in this case, what I do is I take my inventory dollar value off the income statement, divide by my annual cost of goods sold, and that's the percentage of the year I'm tying up the inventory times 365 days gets me my days. We can see in 2009 that Toyota was tying inventory up for 29 days. By 2013, it went to 29 and a half days. So again, they've been pretty tightly controlling their inventory and they're getting around 30 days of inventory. But it's important because 1 day of inventory, if I take 18 billion, 18,210, divide by 29 and a half, is $618 million a day. So again, huge expense in inventory. But I start to see a sense of the cash cycle. I spend cash for 29 and a half days before I sell my product. Then I have to wait another 102.8 days to get paid. And I'm tying up cash at $618 million for every day of inventory and another $730 for every day of accounts receivable. Cash is going to be very important to Toyota. Okay, next we want to look at what's called facility efficiency, or what I would call property, plant, and equipment, which is your facilities. And again, lower is better, but how much am I spending on my facilities relative to my sales? So to get that number, I'd say PP&E, property, plant, and equipment off the balance sheet. Net PP&E is the number that I want, divided by sales or revenue. So in 2013, for every dollar of revenue, Toyota had spent 27 cents or 27% on facilities. So that's important because that tells me that to sell the next dollar, they have to spend another 27 cents. The thing is, in 2009, to sell the same dollar of sales or revenue, they were spending 36 cents or 36%. So you can see Toyota is getting much more efficient with their manufacturing facilities because it's taking them less money to sell the dollar, less investment in property, plant, and equipment. So that's the key to PP&E efficiency and whether a company is getting more or less efficient over time. It's really a measure of utilization. Okay, now we go to the other part of the balance sheet, which is the financing side. Now we're starting to look at their risk. And another question we might ask as an investor is, how much financing is required to run its day-to-day operations? That is known as capital, or in this case, what's called invested capital. Now, some people will call this capital employed. Others will call this net assets. But the idea is it's the total amount of financing off the balance sheet that requires a return that's used to run the business. So in this case, it's all of the debt, short-term and long-term debt that requires interest, plus all of the equity. It's that financing which requires a return that's called invested capital. Okay. And so in this case, if I go to Toyota and I look up all their debt, short-term and long-term in 2013, they had $150 billion. If I look up their equity, they had $135 billion. If I add the two together, they had $285 billion worth of debt and equity to finance their business, which means they have to get a return on investment in order to pay back these people because the debt holders want interest, the shareholders want dividends. So they have $285 billion worth of long-term financing that's going to require a return. Well, that $285 billion generated $267 billion worth of revenue. So another way of saying that is that to generate $1 of sales, they had to borrow $1.07 of debt and equity. So this is a measure of capital to sales of the overall productivity of the financing. So in this case, think about 2009. To generate the same dollar of sales, they had to invest $1.20. So $205 billion of revenue required $245 billion worth of investment. Now, by 2013, $267 billion in sales required $285 billion of investment. You can see that Toyota is actually getting more productive. They don't need as much capital to generate the same amount of sales. So in 2009, to generate the next unit of sales, they had to borrow $1.20 for every dollar of revenue. Now they only have to borrow $1.07 for every dollar of revenue. Toyota is getting more efficient. And part of it, we saw on the last slide, it's they don't need to spend as much on property, plant, and equipment to get the same amount of sales. In 2009, you can see $74.5 billion of property, plant, and equipment gave them $205 billion of revenue. By 2013, less property, plant, and equipment gave them a lot more revenue. That was one of the big reasons why they were getting more efficient. They didn't have to keep borrowing more money for more property, plant, and equipment to essentially generate more sales, and that allowed them to be more productive. Now, from an investor standpoint, what I really want to know is, what does this also tell me about their productivity in terms of cycle time or days? So can I translate this into a days number? Or basically, how long does it take to turn that investment, when they spend that money, that debt or equity, to collect the cash, to turn the investment into sales and actually collect the cash? How long does that take overall as they run through the operations of the business and wait to get paid? Well, that's what I call the total days to the cash cycle. And to get that number, what we do is we take the invested capital, which in this case is the 285,778, and we divide that by the annual sales or revenue, the 267,026. That's the percentage of the year that we're tying up the cash. Multiply by that by 365 days, and that tells us the length of the cash cycle. So the $1.07 in the previous slide, said another way, is 391 days. So in 2013, the average financing was tied up at Toyota for 391 days. In 2009, that was 437 days. Toyota is getting faster. They're becoming more efficient. And that's important because every day of invested capital, the debt and the equity, is tying up $732 million worth of cash. So the longer their cycle, the more money that they're going to have to tie up. The opposite is true. If they get faster, it's like squeezing a wet sponge. The investment is being freed up and it's being able to either be repaid or being used for other purposes. And that's a key productivity measure of the business. When we tie this all together, this is what the investors are going to care about. What's my return on investment? In this case, what is my return on my invested capital? Now, from an investor standpoint, the company is going to have to pay taxes before the investor gets the money. So I want to look at the profit after tax. And if I want to really invest in a business, what I'm really investing in is the operations of your business, the performance of their business that actually sells products and services to customers. So when I look at return on invested capital, or ROIC, what we do is we take the operating profit or EBIT of the business, and we assume taxes are paid on that. So we multiply by 1 minus the tax rate. And what's left is the NOPAT, or the net operating profit after tax. So this is the cash profit from the business from operations, that NOPAT. And I divide that by my invested capital, how much debt and equity I've tied up in my business. So that tells me what return on my investment as an investor that I'm getting for you running your business. So in this case, generally, most companies in the US and Europe have earned somewhere around 9 to 10% historically. So that's a reasonable benchmark. But again, I'm going to eventually compare it to my cost of financing. But here's the key thing. The absolute return on invested capital, or return on investment Toyota make in 2009, they lost money on their $245 billion investment, which means for every dollar I invested, I lost almost 2 cents. By 2013, for every dollar I invested, I made almost 4 cents. Obviously a lot better performance. However, the average company over the long run earns 9%. So despite Toyota's improvement over the last 5 years, they still have a ways to go to get to the long-term average for a company. Now, I'll also look at it as an investor to see whether this debt that I put in the business is going to be able to be repaid. So what is the risk of the balance sheet? Well, the most important risk measure to a balance sheet is something known as interest coverage, which is how many times with my profit can I pay my interest expense? And the more times I can pay that interest expense with my profit, the more of a cushion or buffer I have, the less risky the business. So 2 ways of looking at this. 1, I look at my EBIT or operating profit divided by my interest expense, and that's known as interest coverage. So in 2013, Toyota generated $15.9 billion of EBIT. They had $278 million of interest expense. They could pay their interest 57 times. That's up from 15 times in 2012 and 16 times in 2011. So I'm probably not too worried about the interest expense because Toyota has a great ability to pay. As a matter of fact, the related ratio to this is to look at what's known as my cash interest coverage, which is instead of looking at my EBIT, I look at EBITDA, which is the cash profit, divided by interest expense. And that, even when Toyota was losing money, on a cash EBITDA basis of $10.3 billion, they could still pay the interest expense 22 times. And today, almost 106 times. So generally, anything above 9 or 10 times is considered very good. Anything below that is considered a little bit more of a risk. So 2009, 2010 was obviously a little bit more of a risk on the interest coverage side, but the banks would also look at the cash interest coverage when you exclude depreciation and see that Toyota was still able to comfortably handle its debt. Finally, does Toyota have enough cash to pay its short-term obligations? Another way of thinking about this is current assets represents the assets that can be turned into cash in less than a year, and current liabilities are what's due in a year. So one of the things I can look at as a bank is current assets, how much cash is expected to come in the next year from my balance sheet, current liabilities, what's going out, what's the ratio of current assets to current liabilities. So if I have more liabilities than assets, then I'm going to have potentially a risk of payment. If I have more assets than liabilities, then I should have enough cash coming in to cover what's due. So that is known as the current ratio. So I take the ratio of current assets, cash coming in, to current liabilities, cash going out, both for the estimate for the next year. And if my current ratio is above 1, then I'm generally considered to be reasonably certain that the company is going to have enough liquidity to pay its obligations. If it's below 1, then I have to make sure they have access to financing to potentially cover gaps. Now the other ratio, so Toyota's at 1.1, which means $1.10 of current assets for every dollar of current liabilities, and they've consistently been above 1 for the last 5 years. So again, pretty comfortable that Toyota has enough cash to pay its obligations. The quick ratio is saying if you take inventory out, because we're worried that maybe they're having an inventory problem and nobody wants their product, can you still, if you take out inventory, pay your current liabilities? So current assets minus inventory divided by current liabilities is called the quick ratio. Again, Toyota is still almost 1 times coverage of their current liabilities, even when you exclude their inventory. So again, Toyota seems pretty liquid. All right. And then finally, on the risk side, we'll look at sort of what we'll call the debt to equity ratio. Because if there's more debt in the firm, more liabilities in the firm, then that's more financial risk. Because shareholders don't have to be paid every year, the banks do. So one of the ratios that we'll look at is what are called a series of what's called leverage ratios, what's known as the capital structure, how much debt to equity there is in a firm. So one of the leverage ratios is actually known as asset to equity, and it's how many assets divided by how much equity, the difference being liabilities. So a higher number means a little bit more financial risk. So in 2009, if I take Toyota's assets and I divide by Toyota's equity, I get a ratio of 2.7, which basically means for every dollar of equity, they had $2.70 of assets, or therefore $1.70 of liabilities. In 2013, for every dollar of equity, they had $2.80 of assets. So they've taken on a little bit more liability risk, and we can see this in the liability to equity ratio. Toyota had 170% liabilities for every 100% of equity, and by 2013, a little bit riskier. Now, given that their interest coverage is pretty strong, and given that their current ratio is pretty good, I don't think investors are all that worried about the extra risk they took on, but nonetheless, we can look at this trend over time. Next, we also have what's known as the debt to equity ratio. And so again, it's literally the debt divided by the equity as opposed to the liabilities, which include things that are non-interest bearing. And in this case, Toyota has 130% debt relative to its equity. Generally, when you get well past 100%, that means you're taking on more financial risk, but as long as you have the cash flow to pay it, then that's not going to be a concern, but it is a number we'll track over time. So the other way to look at this is debt as a percentage of financing, a very similar way of saying this. Debt divided by invested capital, which is debt divided by debt plus equity. Toyota is using essentially 53% debt in its capital structure to finance itself long term, down from 57%. So in a way, Toyota is taking on more liabilities, but they're not taking on more interest-bearing debt relative to equity. So really, it's the non-interest-bearing liabilities that Toyota is using to finance its operations. That's what we can see from this screen. So this has been a general overview of some of the key questions, the key indicators, and the formulas associated with reading and interpreting an income statement.